So we'll be doing Compiler Limited, all right? So as good exam technique, we know to always start with required, okay? So it's asking us to prepare the asset section of the statement of financial position, as well as the relevant notes thereto of Compiler Limited at 31 December 2018 to comply with the requirements of IFR, International Financial Reporting Standard, IFRS. Okay, so the first thing when you're going into these type of exams is just like have your layout ready, right? So you wanna know and understand the structure of the statement of the financial position, okay? And then know your non-current assets, where you're going to put them, and then also your current assets. So you remember that your current assets are those assets that will be realized within 12 months, and then your non-current assets are the ones that will be realized over 12 months. Okay, right. So then, since they've asked us for the statement of financial position, um, you know, that there will be, because they're also asking for the notes to that, so you probably want to lay out your PPE note as well, okay? And then also just learn the structure that it's the carrying amount at the beginning of the period, right, which consists of the cost, right, original cost, and then accumulated depreciation up until the beginning of the period. Then you have the movements of PPE, which consist of depreciation, additions. These additions, very important, is that the additions are at cost, and disposals are at carrying amount. So when you buy a new asset, it will be at the cost that you put it in your PPE note, and then when you sell an asset or trade in or whatever, then you know that it's done at the carrying amount. Okay. And then there's the depreciation capitalized. We'll get into that as we do the question, and then also the revaluation of the land. Okay, and then in the end, you've got your carrying amount, which will again consist of the cost or the valuation date value, less accumulated depreciation, which includes depreciation of the current year. Okay, so you just want to have that structure ready so that it's easy to work through, right? And you want to be in the habit of generating marks throughout the question, so such that if you don't get time to finish, then you've scored the most amount of marks possible, and you achieve that through good exam technique, which I'm hoping is what you will get from this session that we're having. Okay, right. So we'll start with the information. Okay. The following information was taken from the financial records of Compeller Limited, a manufacturing company, on 31 December 2018. Ordinary share capital is 5 million. You've got land at 1.2, buildings at cost, okay. Machinery and equipment at carrying amount, all right. Accumulated depreciation of the different assets, investments at cost, loan and inventories, trade and other payables, bank, provisional taxes paid, and trade and other payables. Okay, so I mean, with the financial records, that's basically, they'll combine sometimes. Sometimes they'll give you a trial balance. Sometimes, they'll split it. I know, especially in the group statements, they like splitting it. They'll probably give you like the income statement and statement of changes in equity separately with the statement of financial position, but that shouldn't throw you off. Okay, doesn't matter what they give you, that what are the components that belong in statement of financial position. Okay, and that's the information that you want. Okay, so for example, ordinary share capital of 5 million here, it's an equity item, so for our purposes it's irrelevant. It's a statement, if they asked for the whole statement of financial position, then yes, we'd have it there under equity. But because they're only asking for the asset section, you know that your um like your trade and other payables and liabilities will not be included. Okay, all right. So very important to know that. Okay. And then we have the notes, right? The additional information. Okay. So even in this layout here, you want to take note of when this information has been given to you. Okay. Because sometimes they give you like a carrying amount at a different date, because now if they say that all of this information is on the 31st of December 2018, and then they're giving you some items. So it's not all of them that are already at the end of 2018, some transactions have not been accounted for, hence why they just give you some of the carrying amounts um, before the start of the year, and then you need to factor that in via the additional information. Okay, so Compella acquired land situated at ERF 1234 Roslyn Tshwane on 1 January 2015 for an amount of 1.3 million. The land was revalued for the first time 28 February by Ms. Jomo, a sworn appraiser, to a fair value of 1.5 million within 4 months of acquiring the land. A factory building was completed and available for use on 1 May 2015. The cost of this building amounted to 4.8 million. On the 1st of January 2018, an office building was built on this land. The office building was completed and available for use on 1 June 2018. The total material and labor costs of the office building amounted to 1.2 million. The company withdrew its machinery and equipment from normal production for a period of 5 months during the current year and used it in the construction of the building. But the factory and office building are owner occupied. The following transactions in respect of motor vehicles took place during the year. On 1 January 2018, Compeller Limited entered into a contract with ABC Motors to lease a new motor vehicle for a non-cancelable lease period of 4 years. Starting on 1 January 2018, Compeller guaranteed ABC Motors that ABC Motors will receive a residual value of at least 300,000 for the motor vehicle. On 1 January 2018, Compeller Limited expects that it will have to make a payment of 150,000 under the residual value guarantee. On the same day, ABC Motors Limited determined that it will sell the motor vehicle to an independent party for 400,000 at the end of the lease term. So that is like the official residual value, because the residual value is something that must be agreed upon with the um, with both parties, So yeah, we'll just get into the detail of that a bit later when we get to this leases section. Okay. Um, all right, and then these are the direct costs that ABC Motors incurred, and then Compeller incurred initial direct costs of 3,000 related to the lease agreement. Okay, then annual lease payments in arrears are 246,367. The fair value of the motor vehicle on commencement date is 1 million. Ownership of the motor vehicle will not be transferred to Compeller at the end of the lease term. On 1 January 2018, a motor vehicle with an original cost price of 240,000 and on which 144,000 was already written off as depreciation on 1 January 2018 was sold for 74,000. There were no machinery and equipment purchased or sold in the current financial year. Property, plants, and equipment are depreciated as follows. Machinery and equipment 20% per annum according to the reducing balance method. Okay. Motor vehicles 20% per annum according to the straight line method. All right, and then buildings 2% per annum according to the straight line method. Okay. And then investments consists of 25,000 ordinary shares in Kaiser Limited, purchased at 450 per share for speculative purposes. The total share capital of Kaiser consists of 300,000 ordinary shares. Each share carries one vote. These shares are traded on the JSE, and the fair value of these shares was 550 each on 31 December 2018. Okay, so these ones are for speculative purposes. Okay, carried at through fair value, through profit and loss. So we know that they come under current assets. And then 80,000 ordinary shares in Pirates Limited at a cost of 160,000. The total issued share capital of Pirates consists of 100 ordinary shares, right? So that's 80,000 out of 100,000. Okay, so that means 80%. Meaning that Pirates is a subsidiary. Okay. Uh, I don't like that fact because I'm a Pirate supporter. I'd rather have Kaizer Chiefs being a subsidiary of Pirates, but I didn't draft this question. Now that I think about it, should have picked another question, but that's a story for another day. For now, we'll just accept things as they are. Okay. Each share carries one vote. These shares are traded on the JSE, and the market value of the shares was 160,000 on 31 December 2018. Okay. Then we have inventories at cost, consists of raw materials, work in progress, and then just before year end, the room where the raw materials was flooded. Um, the flooding resulted in 40% of the raw materials being damaged to the extent that it cannot be sold or used. It was determined that the net realizable value of the raw materials that were not damaged was 50% below the cost thereof. The net realizable value of the work in progress was estimated to be 280,000. Okay, right. And then a loan was granted to Pirates' subsidiary to the amount of 132,000. The loan is interest free and is repayable in four equal installments. The first installment is payable on 31 December 2020. Okay, so you know what I normally do, okay, is that um, after having read the notes, I can already see which items are um, less complicated, okay, and I usually try and get those out the way, so start with like the easy marks first if possible. And by easy marks I just mean that like notes that are not too long, the ones that are pretty much straightforward, and then I like to go finish with some of the more complicated notes, the notes that affect more than one line item, and so forth and so forth. Okay, so here in this question, okay, uh, I can already get going with like, for example, trade and other receivables. I know that trade and other receivables, it's got no note to it. There was nothing mentioned here at the bottom. I can take it straight to my statement of financial position over here. Okay, so trade and other receivables, 480,000. Good to go. You know. Um, all right, good to go there. Okay. Then just give me a second there. All right. Okay. Then I've got uh bank, cash and cash equivalents. Okay. Also not no notes there, nothing affected it, presented at the 18th of or the 31st of December 2018. And then I go in and I slot it in, you know. You see, I don't know about you, but for me, when I start putting in these figures, it's like I'm getting points on the board. So it's like I'm scoring. It's like I'm a striker for Pirates, you know, and I'm already scoring the goals. So I'm gonna beat Kaizer Chiefs, you know, helps with the confidence, um, as opposed to just like going straight deep into the difficult questions and scratching my head and getting confused and under pressure, and then I forget about some of these easier things to do, so yeah, that's how I approach questions and exams. Okay, so then already like with these financial assets. Okay, so this one, the ordinary shares in Kaizer Chiefs, right? Um, you know, um, they say that these shares are traded on the JSE at the fair value of R5.50 per share, and we have 25,000 shares. Okay, so we know that when we come straight here to the financial asset at fair value through profit and loss, then we've got R5.50 multiplied by 25,000, and then boom, I've got that sorted out, done. Okay, right. Then the investment in the subsidiary. Okay, so you know that from because when you look at this note here, it says a loan. So a loan was granted to Pirates Limited to the amount of 132,000. Okay, the loan is interest free and is payable in 4 equal installments, and the first installment is payable in 2 years' time, right? 2020. Okay, so from your group statements module, right? That when you have like a loan in a sub, right, you're gonna have it, either depending on the duration of when it's due, you see, you will have it either under current or non-current assets. But this one is due in over 2 years. Okay, so you'll have it under non-current assets, and you probably have something along the lines of loan to uh to S. Okay, then you have like your debit and credit. Okay. Um, sorry. Let's maybe put it in other words. You would have your loan that is sitting in your subsidiary as a payable, right? Um, in the separate financial statements, it will be sitting as a payable. Okay. So, I mean, in the parents' books, in the separate books of the parent, is sitting as a receivable, like a long-term receivable under non-current assets. Okay, so the recording of such transactions in the separate records of the parent and the subsidiary represent mirror images of the same transaction, right? As soon as the financial statement of the parent and subsidiary are consolidated, and then the group is recorded as one entity essentially. These items would then need to be set off, like those balances would need to be set off via an intergroup like journal, right? So, from the perspective of at group level, you can't have a transaction with yourself. So you would then have an elimination journal, right? Um, that you would then process in that instance. So you would have loan from parent, okay, um, then loan to subsidiary, right? And then that would be I just forgot how much it was again. Um, 132,000. Okay. So you would have that 132,000, okay, and 132,000. Okay. So in your consolidated financial statements, there would be like this line item would not exist, right? But in the separate books, it was obviously sitting there, hence why you have to eliminate it. Okay. So yeah, that's where this elimination journal comes from, you know. So for you to see it, you know, it's just that here they just have it under one. They don't have like the breakdown of it, you know. But um, essentially, you know, most of the time they'll have it separate, you know. So this investment in subsidiary would normally just be the cost, you know. So that's this investment in subsidiary is from the main elimination journal, okay, that you've probably seen so many times, you know, where you eliminate the share capital, eliminate the retained earnings, um, then you've probably got goodwill, uh, we at like whatever amounts, you know, and then you have investment in subsidiary, and then you've got your non-controlling interest, right? So in those instances, that investment in subsidiary, that would be that amount that's coming from there, this cost, this 160,000 here, okay? Um, like, okay, it's just that this one says, you know, it's carried at market value, but, you know, the market value is equal to the cost at this point, right? So then that's what you would have, right? So when you're consolidating, you would obviously need to write down mark-to-market gains that would have happened, okay? But ultimately, this investment subsidiary is at cost here, and that would be your 160,000, you know, at acquisition journal entry, all right? Um, Main elimination journal, okay? This is at the point which the parent acquires the subsidiary, and that's the 160,000 that we're talking about here. Okay, so yeah, that's why I was saying, you know, normally it's separated because of that reason, you know, but over here it's combined in forming part of it, with, you know, which is you know, acceptable. Okay, so then there you'd have your 160,000 plus your 132,000 of the loan. And then that's 292,000. Okay, right? Um, then we also saw the inventories. Um, there's not a lot to it. Okay, just a couple of workings. Okay, so we know that inventory is carried at the lower of cost and net realizable value. So in this case here, we see that the work in progress is 250,000 and the net realizable value of the work in progress is 280,000. Okay, so the lower of it is cost. We'll keep it there. I think I just put the calculation down here somewhere. Okay, so that's the inventory. Okay, um, which we will have at 250,000. Okay, then the raw materials must be at NRV, right? So the remaining raw materials we saw from the question, um, they said that 40% of them got damaged beyond sale, so got like zero value. Okay, so then just need to get that value, starting value was 380, right? It's 380,000. Okay. Um, so it was, so now you say 380,000 multiplied by 60%. That's what you have remaining. And then they say this that is remaining, right, has been written down by 15%. Okay, so we times the 15%. Okay, and then the value of it is the 280 minus that 15%, and that's the value of our raw materials at net realizable value. Okay, right. Then okay, yeah, I just put a formula in there already, but it's essentially adding the work in process and the raw materials to give you an inventory value in the statement of financial position. Okay, so now we're done with the current assets. Okay, done quickly, now we can focus on some of the more difficult stuff, um so we'll then go on to like the leases question. Okay, that looks pretty straightforward. All right. So I mean, the first thing that we realized is that they didn't give us the discount rate, right? So we have to work out the implicit rate in the lease, okay, so that we can work out our right of use asset. We know that our right of use asset consists of the minimum payments under the lease, right? And then adding obviously also the initial costs in that, to get us to directly attributable costs and stuff like that, to get us to the right of use assets, and then that's what we depreciate going forward. Okay, so when we're working out the lease liability portion of it, right, we would need that discount rate. In this case, it would be the implicit rate in the lease. Okay, so let's get going with that. Right, so when we work that out and we calculating the implicit rate in the lease, okay, we've got at the present value, right? You see, present value of from the lessor's perspective, okay, right, is the fair value of the asset, and direct costs incurred by the lessor. All right. So we got from the question that the fair value of the asset is 1 million, and they have incurred 5,000. Okay. The directly attributable costs. Okay. Then the future value consists of the guaranteed and unguaranteed portion of the residual value. Okay. So here in the question, they gave us the residual value. Okay. So the theory is that the residual value will be equal to the estimated market value of the asset at the end of the lease term. This will enable the lessor to sell the asset for that amount, right? The residual value will be an estimate, and the lessor will not be certain what the market value of the asset will be at the end of the lease term. However, at the commencement date of the lease, the lessee and the lessor could have a contractual agreement where they agree on a residual value guarantee amount of the underlying asset at the end of the lease term. Okay, the residual value amounts can be fixed, or they can be variable, right? The residual value will be variable if, for example, the estimated market value of the asset is lower than the agreed residual value guarantee, then the lessee will have to pay the difference to the lessor. This amount is the expected amount payable by the lessee under the residual value. So within the residual value, there's an amount that is guaranteed by the lessee. Okay. So hence why, right? The standard defines the unguaranteed residual value as the portion of the residual value of which the lessor is not assured of. So in this case, the residual value of the asset is then 400,000. Okay, right? Then the lease period is 4 years. Okay, then the payment is I think at the top